Well, the result that put everything else in the shade this week was BHP Billiton. It wasn't so much the $15 billion profit or the fact that it was down that captured the headlines, but the decision to shelve some big projects, especially the Olympic Dam expansion. So is that a harbinger of the end of the boom or just strategic belt tightening? I spoke to BHP Billiton chief Marius Kloppers from London after the results came out on Wednesday night. Well, Marius Kloppers, the decision to rethink Olympic Dam has obviously been a big shock to Australia. It's sort of the first concrete indication that at the very least the mining boom can't be taken for granted. But it's a turning point for BHP as well, isn't it?
Alan, if you look at our CapEx, we spent $20 billion last year in CapEx. We hope to spend $22 billion this coming year. In reality, what we are talking about is just slowing the rate of CapEx growth going forward. So I must emphasize that we're clearly going to be investing a great deal of money over the next 12 months, and we hope to invest that wisely and get a good return for our shareholders.
There's obviously a lot of political debate about this. Can I just clarify, did the carbon tax and the mining tax have anything to do with the decision?
The mining tax really has not changed for this mine ever since it was incepted, and certainly when we bought it from WMC. So that's not a factor. The real driver here is that there have been general industry-wide cost increases, which when coupled with high energy costs, which is what you use a lot, i.e. diesel, has just put the concept that we have been developing into a non-economic space. So it's really about the project specifics and capital cost escalation that has caused us to defer this decision. You know, we still think that this is a wonderful ore body that is going to be a very major copper mine in due course.
So what's your new timetable for it?
Alan, we don't have any timetable. We've been very clear that it's beyond the 12-month time frame, but it normally takes a couple of years for us to work from concept through to definition, as we call it, and we are putting this project back all of the way to selection phase study.
It's also a fact that your cash flow has fallen a lot. It seems to me, just looking at the money that's due to come in this year and due to go out, that you're going to be borrowing to pay the dividend. Is that right?
Well, we're likely to, all else being equal, we're likely to utilise some of the balance sheet capacity, which, of course, is what you do if you've got projects that are nearing a delivery. However, you will have heard us say before, we've got to live within our means, and hence today we were very deliberate in saying we are going to slow down the rate of incremental project approvals going forward, because we need to, over time, match the cash outflows with the cash inflows.
So what do you estimate the cash hole is going to be in 2013?
Alan, I prefer you to not use the word hole, obviously. We are investing $20 billion in projects which have near-term growth. We think at today's price deck, a 15% plus real return after tax for our shareholders, which is obviously hugely value accretive. A balance sheet of $170, $180 billion company obviously is part of that funding strategy through the cycle, as long as we maintain the gearing level on the balance sheet within our targeted A rating, which we've recommitted to again today.
In the latest year, what we saw was an increase in volumes, but a decrease in prices, and they didn't offset each other, so profit fell, of course. What do you see happening to both volume and prices over the next 2 years?
We are less capable of predicting the short run, and quite candidly, it makes a smaller difference to us than people commonly think. We are a business that takes capital, takes a long-term view of where prices and demand is going, and invest that in the products that are going to be most in demand. Our long-run forecast is for prices to mean revert. Therefore, the emphasis today on cost control. Secondly, We believe that some products are going to be more attractive than others.
By mean revert, do you mean go down?
Go down. Go down. Yes, indeed.
By how much?
No, Alan, I wouldn't like to I can't make a short-term price prediction, but our long-term price protocols are by and large across the product suite for mean reversion of prices towards longer-term pricing points that are lower than today's prices.
But what sort of volume performance are you predicting, and will that offset the price declines that you're forecasting?
Alan, without wanting to make a very precise prediction, I would be not satisfied entirely if we didn't manage to grow volumes by about 10% or so over each of the next 2 years.
Yeah, but you need someone to buy that. I mean, the Chinese economy is not growing as quickly.
The rate of growth in China may have slowed down a bit. China's economy is very definitely still growing, and growing at the highest rate of the major economies in the world. We believe that while the absolute demand growth for products is going to be lower than we've seen in some recent years, we still believe that there are very attractive opportunities for our company and indeed for Australia. Now, I caveat that in one way, which is we have never been as exuberant as others. We have always been we have to work we have to sing for our supper kind of a world. So, that's pretty much still where we are.
Thanks very much for joining us, Marius Kloppers.
Alan, it's good to talk to you again. Thank you very much.